Hello everyone. In this lecture, we shall be discussing the basics of security analysis. This is chapter 4 of ASM. All the investment decisions with respect to securities or shares, it all circles to which security shall we buy? What is the share which we shall purchase out of a various pools of securities available in the market? So let us assume there are multiple securities available in market and you wish to make an investment in a security. What will be your criteria when you decide or when you plan to buy a security from the market? Is it the return? The security with the highest return, is it that which you will be going with? Definitely not. That is only partially correct. You should also see the risk involved in that particular security. So ideally, what we shall be seeing is the highest return per unit of risk or the lowest risk per unit of return. So these are the criteria or based on which we shall be deciding how to make an investment in an equity or a share. Now, suppose we have a portfolio of various equities in it, and we have decided, like while buying each of the securities, we have decided which is that security where I am getting the highest return with the risk or the lowest risk with respect to the unit return. And I have bought all the securities, but however, these risk return profile of a security keep changing, not just with this security, but the overall security available outside. So we should also think of swapping one security from my portfolio and buying another from the market based on the changes in the risk and return portfolio profiles of the security. So always an analysis is required on a continuous basis. We should keep analyzing all the securities so that we could make a proper investment decision. Now, such analysis of all the prospective securities is known as security analysis. Security analysis involves a systematic analysis of the risk return profiles of various securities. Security analysis involves a systematic analysis of the risk return profiles of various securities. Now, suppose an analyst, he has done a proper analysis of a security and then he understood the true value or the worth of a security is say rupees 100. So after all the analysis, after all his findings, after considering all the information available to him, he figured out the true value or the theoretical value of that security is 100 rupees. Now, to make a decision whether to go with the security or buy the security, he should also see what is the market price of the security. If in the market this particular security is available at 90 rupees, he will definitely go and buy the security because he is sure, based on his analysis, he knows the theoretical worth of the security is 100 rupees. Tomorrow, the security, there is a high chance of going up to 100 from present 90 rupees in the market. So it is a right decision to buy the security. Now, however, if the market price is say 110, then he will not buy the security because he knows that the theoretical or the true value or the worth of the security is 100 based on his analysis. Based on his analysis, it is 100, and in the market, it is coming at 110 rupees. So he will not buy the security. So this is how security analysis is used in making an investment decision and building a portfolio. Now, the approaches of security analysis, there are two approaches. One is fundamental analysis and one is technical analysis. We will see some basics of fundamental analysis here. Fundamental analysis assumes share prices depend upon future dividend expected by shareholders. Fundamental analysis, it assumes that the share price always depends upon the future expected dividend of the shareholders. And any asset, if you take in that matter, one of the methods of finding the value of an asset is using the present value of future cash flows. The present value of future cash flows. In future, what all are the income which this asset will entail? And based on that, we should compute the present value that will be the worth of the asset as on date. Similarly, for an equity, The future cash flow is its dividend. And fundamental analysis says the true value of this equity is the present value of its future dividend. The present value of future dividend is the intrinsic value of that share, or which is the true value of the share, or which is the theoretical value of the share. So this is how fundamental analysis computes the value of share, or this is how it analyzes the securities and arrive at the value. Now, after computing this true value, if the market price is less than the intrinsic value by the share, that is what we have discussed here. If the market price is less than the true value of 100, you should buy the share. If the market price is more than the true value or the intrinsic value, you should not buy the share, or you should sell in case if you are already having it in your portfolio. If you are already holding this, you should sell the share, right? Now, let us see, assume if the expected dividend of all future years is the same D, and we should find the present value as D divided by 1 plus K, where K is the discount factor. So this is very simple method. We are just finding the present value of all future cash flows, and with interpolation we can arrive at P is equal to D divided by K, where K is the desired rate of return by the shareholders. An investor who is planning to buy this share, he knows that, or he is expecting D to be the dividend every year, and he's expecting a return of K percentage, then he can discount this dividend using K percentage and find the present value as P. Now, fundamental analysis, this is just a simple example, the simplest way of explaining fundamental analysis. So fundamental analysis uses such models or variations like a similar way, how we did here, similar way, such models or variations in estimating the fundamental or intrinsic price of securities. In similar way, fundamental analysis, not just this method, there are various other methods also, but fundamental analysis uses such methods in arriving at the intrinsic value of securities. Now, going a little wide into the topic, prospects of a company will also depend on industry which it belongs and also the overall economy. So when the overall economy is in recession, the whole industry as well as that and a company which we are analyzing, everything will have a bad time, and the dividend expectations will come down, and the price of equity will also come down. So we should also factor in such factors like economy and industry when we are doing fundamental analysis of equity. So fundamental analysis encompasses three things: economic analysis, industry analysis, and company analysis. These are the three things. When we talk about industry economy analysis, it is the income growth percentage of the people, national income, it could be recession, it could be market growth. All these factors will come into play when fundamental analysis is done. Inflation, growth rate of national income, stagnation or degradation in the economy, which is recession, trends in people income and expenditure. So all these are the various factors which we have to consider while we do the economic analysis, which is a part of fundamental analysis.